And okay, we look at the gold-silver ratio and all the rest of it and get excited when it sort of starts collapsing, which it has been doing, which is very exciting for the bulls. Fine. But the reality in silver is that it's industrial demand which is driving it. And here you have a problem because you have the pricing being in derivative markets, basically, but the demand being for physical. And it's that interplay which is suddenly creating a crisis for those dealing in derivative markets. Because what is happening is that people who need silver for industrial purposes are being forced to go into the derivative markets. And in the case of COMEX, stand for delivery. I mean, this year so far, around about 15,000 tons of silver have been stood for delivery. Now, we don't know precisely who all these stand for deliveries are, but you can be pretty sure there is a very large element, if not almost entirely, due to industrial entities needing this for manufacturing photovoltaic cells, for electric vehicles, for whatever. So silver suddenly is a needed commodity. And the fact that commodities generally are stirring, you also see the squeeze, if you like, on derivative markets in the platinum group metals. That's been very, very noticeable. And also copper, Dr. Copper. And what this actually tells us is that over considerable periods of time, distortions in the fiat currency system have built up. And the distortions are really very, very evident in derivative markets. If you look at the price of particularly copper in gold, prices in gold is real money. Its value does obviously fluctuate, but not very much over long periods of time. Now, if you look at the price of copper measured in gold, then it's about 18% of its long-term value. In other words, it has been suppressed while at the same time it appears to be rising in fiat currency terms. What this again tells us is that the suppression has been far greater than you would think. And consequently, the rise in the value of copper in the markets is likely to accelerate substantially. And that's before we talk about the fundamentals in the situation. Now, Dr. Copper is very important because, like silver, this is a demanded metal in this new world of electronics, electrics, power generation, I mean, the whole thing. So this is, if you like, a pretty good indicator that the distortions which have been put into commodities by collapsing fiat values, those distortions are coming to an end. Now, the problem as far as derivative markets are concerned is they're not really in a position to handle this. If you look at London in silver, then basically there's no liquidity. And this is why the lease rates spike up. I think it was early in October, they spiked up to over 30%. At that time, there was a backwardation between London and COMEX. That backwardation seems to more or less disappeared. But lease rates are still holding up. We're looking at sort of 7-8%, that sort of figure. The situation has been made worse for the derivative boys because China is restricting exports of silver. Now, the reason this is important is that because China has been managing the price for some considerable time. It's done this. I mean, you and I, Kai, have attended conferences. You run conferences. And at one of these conferences back about, 10, 12 years ago, something like that, I spoke to a bunch of silver mining and silver exploration companies. And I asked them, how do you turn your silver doré into wages and, to pay the energy bills? And the answer was quite simple. They said that the man from Trafigura or Glencore came round, he valued it, told the bank, which was presumably JP Morgan, and on that basis, the account was credited at JP Morgan, and the dory was then shipped off. Where was it shipped off to? Well, we don't know, but we assume it's China. But of course it was China. China not only is today the second largest mining nation by silver output, but it imports dory, not just silver dory, but also other metal dories from which it extracts silver, bearing in mind that over half of silver from mining operations comes from non-silver mining operations. The result is that China has built up a huge, great stockpile of silver secretly. I mean, you can work this out for yourself. It's quite simple. But what China is doing from the beginning of next year, in other words, in a week's time, is it's introducing a new export licensing regime, which is designed to restrict the quantity of silver flowing out of China elsewhere. And this is happening at a time when India, its economy is roughly where China was maybe 20, 30 years ago. It is booming. I mean, it is rapidly industrializing, and its demand for silver is off the charts. Where do conglomerates like Reliance Industries go for their silver? Well, the answer is, they go to the refiners, and refiners say, "Back of the queue, mate." They go into London, and they buy it off the bullion banks, who will sell a forward contract, and then they stand for delivery. They go to COMEX, and they buy futures, and they stand for delivery. So markets are being drained of liquidity, and the problem in London is that you look at the numbers in the silver vaults, and you think, "Oh, there's quite a lot of silver there." Yeah, but it's all ETF silver, and it's calculated that the non-ETF silver, which some people think is the float, is around about 140 million ounces. But a lot of that is actually in firm hands. It's not available in the market. And this is why the lease rates rise. And I would make a further point. I mean, investors look at commodity prices, and they see these commodity prices rising. And they think it's rather like, let's say, dealing in NVIDIA or Microsoft or, one of these things, or even like dealing in a mining stock. And they think, well, it rises so much, you're going to get sellers. Because obviously, when the price rises, it rises to the point where supply comes in and satisfies the demand. So that's the price level. And when you get there, what do? You take your profits. Yeah? But this is not what goes on in commodity markets. There is not that liquidity. The traffic is one way. It's all producers, not so much producers, but it is the industry which is demanding this stuff. And they're all demanding it at exactly the same time. Meanwhile, mine supply is inflexible. And then to have China turn around and say, well, we've told you the story on rare earths. Now telling you the story on silver, and antimony was another one on this licensing thing. In other words, we're being squeezed. We are being very badly squeezed. And the thought that, today as we speak, Kai, the volatility, we saw silver overnight go to, 83, 84, something like that. And then it shot down. I'm looking at my screen here to 74, and it's currently 75. Volatility. Yeah, of course. But has any silver been shaken out? Very, very little. Very little. So this is going to march on. Unless, of course, there is a change in the demand from industrial users. So, the volatility that we see in these commodities is completely different from the sort of volatility that you experience in stocks. And it's a big, big mistake to confuse the two. And I think to sort of round off this bit, really what we are seeing is the demise of the derivative system, if you like, which in the past has been expanded to satisfy demand, basically financial demand for commodities, and therefore kept a lid on prices. That is coming to an end, and the consequences of that, I think, will be far higher prices, not just for precious metals, base metals, but commodities as a whole. And what does that tell you? It tells you that the purchasing power of the fiat currencies are going down.